Hello, everyone. This is Mohammed Akif with Akif CPA. And then today we'll be discussing tax consequences of leaving Canada. So, tax consequences of for the assets that you own in Canada, which could be investments, retirement accounts, uh, just RESPs, rental property, principal residence. So, in my previous videos, I've talked about what happens on the Canadian side when you leave Canada. In this video, we'll be talking about what happens to those investments, assets, property that you own on the Canadian side. What happens on the US side? So, this video is about tax consequences of when you leave Canada and then you move to United States for any reason. What happens on the US side for those? So before we get started, I do want to point out, so this is a series of many other videos that we are doing to give fellow Canadians the opportunity, the information to make better decisions before they move to the United States. I want to simplify the process. I want to simplify the taxation. This area is one of the most complex areas in the tax system. So I want to make it easy for you. I want to make it where you can manage both sides, understand both sides, and then make decisions to simplify the whole tax filing. The ideally you want to be on one side of the border, but sometimes you do need to manage it in a way where you can make it possible for you to manage. Otherwise, what's going to happen is that the laws are always changing, the information is always changing, things are always coming up on the US side majority, and sometimes on the Canadian side too, where you might miss some reporting. You might not be aware of additional reporting that is required on the US side. So there are penalties associated with it. And then so we don't want you to be in a position where you are incurring those penalties, or you are heading towards incurring those penalties. So simplify your taxes, your cross-border taxes. Simplify where you can manage them, and then make decisions where you can really take care of them. And at the end of the day, the whole point of tax planning and understanding this whole cross-border taxation is to get the most out of your move when you move to the United States. You are moving for economic reasons. You are moving for jobs, better paying jobs, and then you want to make sure that you are able to keep the money that you're moving. You're leaving your family behind, your country behind, the people that you've known, the places that you have known, and you are making a sacrifice. So work towards tax saving, to work towards where you can make the most out of your move, and then keep the most money in your pocket. I don't want your money to be wasted in interest, penalties, and fines, where about things that you didn't know, and then you could have made decisions to make it easy. So our whole goal of this series is to give information where you can simplify cross-border taxation for yourself, understand cross-border taxation, how this works on both sides of the border, make decisions to make it easy, make decisions where you can manage your taxes, and make decisions where you can keep the most money, in a country that you're moving to. So let's get started. So previously we talked about what happens with the Canadian investments. So let's start with Canadian investment. So what happens on the Canadian side, as I briefly mentioned in my previous video, in terms of deemed disposition. So on the U.S. side, of course, when you are moving, a disposition has happened on the Canadian side. If that's the case, you didn't close the account, and so a disposition has happened. And then so for U.S. tax purposes, the assets are classified the same way. The cost, what matters. So we do have a tax treaty that we need to take on when we are filing a US return, to make sure that we get the same fair market value as a cost basis on the US side. So there is no double taxation, uh, because this happens quite a bit of unregistered accounts, or securities accounts, or trading accounts, where you do move this disposition on the Canadian side, and next thing you know, we are dealing with the wrong cost basis, and then you end up paying additional tax, in some cases double tax on those assets. So that's one thing. uh, that's Canadian investments. So let's talk about the retirement accounts, which are your RSP account. I will talk about that first. So RSP accounts, they are covered by the US and Canada tax treaty. So in terms of when you do move, there is no tax implication for the federal tax purposes. We do claim tax treaty benefits. Again, we have to claim those benefits, and then there is no additional taxation. You get the same benefit. But depending on what state you move, we do have states that don't recognize federal treaties, and then so some states like California, Georgia, they do tax you on your earnings in those accounts. So the RSP accounts, that the earnings are taxed. Let's move on to, so that was, so we talked about Canadian investments, non-security accounts, registered accounts, secure, investment accounts. Let's talk about, we talked about the RSP. So now let's talk about the TFSA account. Again, we don't have a proper regulation on the US side from the IRS regarding how the TFSA is treated. Some firms will treat the TFS account as a trust account. So there will be a form 3520, 3520A. In our firm, we don't think that this is a trust account. So, but we do have certain disclosures that we do include it with the U.S. return. The U.S. does tax you on the earnings in that account. So even though this is a tax-free account on the Canadian side, but on the U.S. side, it is not tax-free. You do have to pay tax on the TFSA earnings on the US side. So, which could come from any types of investment that you have, could be dividends, interest, mutual funds, or capital gains, you name it. That's how it goes with the TFSA account. So let's go towards the RESP. Of course, when you do become when you are living Canada for tax purposes, you no longer live there, you cannot contribute to RESP. Any earnings you do have on in that account, the US will tax you on that earning too. So again, this becomes a taxable event. Any earnings, interest, dividends, gains that you do get in the RESP account will be taxable on the US side. So that's covered. I mean, so we got the investments covered, we got the RSP covered, we got the TFSA covered, or we got the RESP covered. The FHSA, we don't have any regulations either right now for this account. It is something that we need to look into more detailed. It is something new that started a couple years back on the Canadian side. So I haven't seen much happening. But my understanding is that if this account is earning interest, because it is also pre-tax, we need to have a better understanding of what kind of investments are in there before we can make a decision. So this is a maybe. FHSA is a maybe account right now, since we don't have any regulations. Again, we will include the earnings on the US side. We will include anything in terms of dividend, interest, capital gains that you do earn on the US side, on the US return. So the, excuse me, the HBP, and then which is the home buyers plan, and then the lifelong learning. So these are all related to RSP. So if you do move, you will have to close those accounts on the Canadian side. So there will be no tax issues on the US side. So these accounts are related to RSP. So I'm not very worried about it. The rental properties. So let's talk about rental property. So rental property will be treated the same way. So if they are rental property in Canada, so they will be also considered rental property. In the US, will report the income and expenses. The depreciation is calculated on those properties. We do have a different method because it is a foreign property for U.S. tax purposes. So the depreciation will be there's a different method to it. That's how the rental property is. But you do get the credit for the tax you pay on the Canadian side if you do have any income. We are able to offset any U.S. taxes, but if there are additional taxes, depends upon your income level. That's a separate matter. But we do report the same way on the U.S. side for the rental property. So let's move on to your principal residence that you had in Canada. So if you are filing a full year return on the US side, and if you have sold your main home in Canada before moving, and you are filing a full year return, this is not a 1040 NR, a non-resident return, or a dual status return, then we will report the main home principal residence selling of the main home. So we do report that. So if you're married filing jointly, so you get up to 500,000 of gain exempt from tax. So if you have lived in that house for 2 years in the last 5 years, so 2 years out of the 5 years, if you have lived in that main home, you get a full 500,000 exemption capital gain. So this is USD. So if you, let's say for example, if you have not lived for 2 years, so with the 500,000 does get prorated based on number of days you have lived in that house. So if you are single, that will be considered 250,000. If you are married filing jointly, the gain is 500,000. So depending upon how what kind of status you have. So if you're single or you're married, the gain that is not taxed would be calculated. So if you are filing a full year return the year that you move, depending on when you move, in a full year case, the gains are 250,000 for single, 500,000 for married filing jointly. We get that exemption. There is no tax on it. It is your main home. You get the same benefits. But if there was if you are filing a non-resident return or dual status, then this will not be reported because this is prior to moving or when you're considered non-resident. So these are the tax consequences of leaving Canada on the assets that you own by the time you move. On the U.S. side, so I've discussed the Canadian investments, the retirement accounts, the RESP accounts, the TFSA, the rental properties, and principal residence. So this is what I've covered. So again, the whole idea is to help you make better decisions. If you find someone who can help you with the tax planning, cross-border taxation, it is very important. I want to be able to make better decisions for yourself. I want to give information. We are here to help you. So in a case where a Canadian has already moved, we can help them too. If it's somebody recent didn't know about this, a Canadian who's moved to US for any reason and didn't know about tax planning, didn't know about how the US taxes the assets and how US system works versus the Canadian, they're just getting to know this. If they have filed something on their own, they didn't know about it, we can help them. So reach out to us, info@akifcpa.com, with your information, and we'll gladly help you get on a call with you, and then help you streamline the process where we can simplify the tax filing. So again, email info@akifcpa for any questions. We are to help you. This video was about tax consequences of leaving Canada on your assets, and then how it is for the US side. So we'll be doing more videos. Next, we'll be talking about how the final Canadian tax return should be, how the first year tax return, U.S. tax return should be, what kind of information generally should be in there for you to gauge. Okay, this is how things will be, and then we'll be covering more topics later down the road. Thank you.